All right, folks, welcome back to the channel. This is Jason. I joined this morning. It's one of the first videos that I put out in a while. I've been doing mostly live streams, but I wanted to talk today a little bit about what's going on in the stock market and some of the shifts that I've seen, particularly regarding Google searches and which stocks are coming up most frequently in Google searches. Some of them make a lot of sense for me because there are some negative things going on in the economy, and some of them don't make any sense whatsoever. And a few of them tie back into what I was talking about with SoFi. And we're going to take a look at that here as the day goes on. But I wanted to start off with a quick recap of what's going on in markets. So the Dow, of course, is up a half a point today, basically 177.54. The NASDAQ was up 1.76%. Most of the heavy lifting, guys, let's be honest, was done by Tesla. Tesla's up about 50% now on the last 2 weeks or so, which is absolutely fantastic. It was getting me a little depressed before. So got to admit, I've been a long time Tesla investor since 2011. So I've been through these down periods before where I've gotten beat up. I've even been underwater on Tesla stock for like almost 2 years at some point. But I'm a buy and hold investor. I'm going to hold Tesla stock for as long as possible. I haven't been entirely pleased with the behavior of Elon Musk lately, but the results speak for themselves. Tesla's earnings were really good. Did they meet all expectations? No. And they weren't in the category as not as bad as we thought. These are really good results. The volume of sales looks good, revenue looks good, and of course, profits look really good. And let's remember the price cuts are there not necessarily just to spur demand, but a lot of it there is to add to market dominance, market share dominance. But a lot of this also, let's remember, Tesla has some of the lowest cost of doing business in the entire auto industry. They have more margin per vehicle. They can afford to cut. And that, based on what I heard from the actual call that Elon Musk was on, is that was kind of one of the primary motives there, is that a lot of people want to buy electric vehicles and price was a big concern. They've got room in their margins to make those cuts. They don't have a dealership network. They don't spend anything on advertising costs, which is something that the big automakers all do. They have that extra in their enterprise expenses. Tesla does not have that. So Renee Alfonso, first one to say hello, everyone. That super chat features are on if you feel so inclined. I would really appreciate that. And yeah, the results reflect Tesla's business before the price cuts. Not entirely before the price cuts. Remember, there were some early December price cuts as well, and then some late December price cuts. So that reflects business going through December 31st. But you are correct that we're really going to see the price cuts continuing into this quarter. A lot of that also had to do with making sure that certain models of Tesla vehicles were going to be eligible for the federal tax credit. The federal tax credit is a huge incentive. I know listening to the All In podcast, there's an argument from those guys on there that the EV industry doesn't need these incentives, that these incentives are superfluous. I don't necessarily agree with that. I think it's a big factor in determining in determining the purchase of an electric vehicle versus an internal combustion engine vehicle. So I do see that the subsidies make a big deal. And remember, it's a dollar for dollar against taxes that you owe, which is a huge deal. It is even for people and for people, especially in the highest tax brackets who can afford to buy a $50,000 vehicle. This is what actually helps them out a lot. A tax credit doesn't help a lot of people in lower tax brackets. And when I say lower tax bracket, if you were in the 22, 24% tax bracket, it doesn't actually help you out that much. Okay. Your taxes really aren't that high, even though you may feel like they're that high. Look, I look at taxes, pretty much every quarter. I look at, 50 to 100 different tax returns, taking a look at what people are doing, taking a look at what people are actually paying. The majority of the benefit actually goes to people who can afford to buy a $50,000 car. I know that's kind of disappointing to people, but it all helps to, in the end, drive down the cost of production of electric vehicles. and to push the affordability of electric vehicles further and further down that value chain. So people driving your Toyota Corollas, or wait, do they even make Corollas anymore? But people, driving cars in that class will eventually get a $30,000, $25,000, $30,000 vehicle in that class with good range, good functionality that is electric as well. So, yeah, lots of things to talk about today, but I did want to go over a few things, in particular, just a few headlines. I've read past the headlines on a lot of these. Of course, Tesla earnings show the path to domination is on track. I would say that that's true. Now, Tesla didn't commit to selling 2 million vehicles next year. Their commitment is, I think, 1.8 million vehicles. Their production capacity right now is right around 2 million vehicles. By the end of the year, their production capacity for the following year, for 2024, is going to be right around 2.975 million vehicles per year. I would expect this year that they are going to announce a new factory location. I think that India, one of those places, or perhaps somewhere in the Middle East, I think Saudi Arabia, look for the announcement later. A little bit more clarity on Cybertruck. Tesla is now committing to limited Cybertruck production and deliveries in the middle of 2023, with ramped up production by the end of 2023 in 2024. So Anthony Walker says, is it a bull trap? In terms of the entire market, a bear trap is what I would call it. In terms of the entire market, you may actually be correct that it could be a bear trap. We still have not seen the full effect of the Federal Reserve raising interest rates and clamping down on liquidity. If you look at this headline right here, the money supply is shrinking, and what that says about the economy, that's actually the first indication we have that instead of a slowing growth of M2, now we actually see a contracting money supply, and we're actually seeing a contracting velocity of money as well, which is very important. That means how many times a single dollar turns over in the economy. So the velocity of money is slowing down, which means that despite the growth in GDP, we can expect some slowing in the economy. Now, recently, the opinions on whether or not we're going to have a recession this year have become more split. In fact, on the way driving my kids to school this morning, I was listening to an NPR economist talk about how he is not predicting a recession this year. I wouldn't go so far as not predicting a recession. And I'm really falling on the side right now of something that I never thought I would do, which is believing that the Fed can actually get it right this time, that we can't have a soft landing, which is a shallow recession that helps control inflation. However, inflation has really been about 2.34% for the last 30 years when we look at how that averages out. I expect that to be higher. One of the firms that I've consulted for here recently, we had a big discussion on where we were going to put inflation, and the number we settled on for projecting the next 10 years was 2.78%. That doesn't sound like a lot, but remember that number compounds over that 10-year period, and that's what we're looking at for long-term inflation. And I was on the side of arguing that we should probably hold out for 2.78% on a 30-year basis, meaning we're going to have slightly elevated inflation pretty much for the next generation or so because of a variety of challenges and reinvestments in our economy, to a little bit of deglobalization. So for some of our higher end products where the margin isn't in it anymore for manufacturing overseas and it has a huge requirement for skilled labor, I expect some of that to come back to the United States. Cheap items, disposable items, I don't expect that to ever come back to the United States, but I do expect those items to become more expensive because of the forces of deglobalization for a bit. So is what's going on right now a bear trap to a degree in terms of tech stocks? It could be. The other way to look at that was the sort of extreme overreaction we had to the slightest bit of negative news which we had in 2022. Look what happened to Tesla stock in that time period. We really didn't see a deterioration in growth when it comes to Tesla. We really didn't see a deterioration in fundamentals when it comes to Tesla. Yet because of Bram says, graph looks like my AFib. Yeah. That's true. So we really didn't see a deterioration in fundamentals when it came to Tesla. What we really saw is negative market sentiment and investor sentiment in regards to what Tesla or what Elon Musk was doing at Twitter, and the fact that it kind of looked like Tesla had a part-time CEO. Let's remember that Tesla is a driving force, a visionary force for Tesla, but he's not the only one that works there. And he's not responsible for actually delivering on things. The people that work under him are, and they're still delivering, right? There's a lot to be said about his involvement in Twitter. I'm not in favor of it. I think he needs to I think that running a social media company and running a manufacturing company are just two very different things, and that he should turn over Twitter. Okay, he's done with all the cost cutting. At least he says he's done with the cost cutting. He should turn it over Twitter, turn Twitter over to a new CEO who understands how to generate money on social media. I'm not sure that he really does. His ideas for verified accounts and all that stuff, they were cute, but let's be honest, it's not working to improve the bottom line. He should be working on right now on reducing the debt load. The interest on the debt alone is about $1.5 billion. And I believe that is more than any single year's profit that Twitter ever made. So for me, if I was, an investor, not just an investor, maybe even someone that he wanted to borrow money from, with a line of credit or something like that, I would look at the outstanding interest on the debt and say, look, this is basically what he paid, and the debt is almost close to the entire valuation of the company at this point, or at least the debt alone is on a private basis. The interest alone is more than the company's ever earned in a single year. What is the likelihood that I'm actually going to be paid back on my investment, even if I'm not directly investing in ownership of Twitter, even if I'm just loaning him money, at 7-8% interest? I would be very hesitant to loan this company, because remember, risk is siloed. He's not signing a personal guarantee on this against his own wealth or against Tesla's wealth. It's really against the performance of this separately taxable entity, which is Twitter, right? It is the liability is siloed in Twitter. I would look at that business and say it's probably not worth the risk, and that I would either have to raise the interest rate, which probably wouldn't do any good, or I would advise him to go out and to sell equity to other investors who are willing to take the advance, willing to take the chance that it could be profitable later on. So, U.S. growth is past one next is key for the Fed. I really don't envy kind of the decision that the Federal Reserve has to make right now, which is, do you ride this out and let the markets recover and economy recover, or do you commit to fighting inflation and essentially engineer a recession? And if you engineer a recession, there's no saying that you can really control how deep or how long lasting that recession is. I don't know that I've ever envied any member of the Federal Reserve, but I definitely don't envy them at this point. So, so money supply shrinking, though, is probably the biggest indicator that all of the good things happening in the market in the last couple of weeks, this is probably the biggest indicator that trouble isn't over, and we haven't seen the full effect of interest rates in the economy at this point. So the Federal Reserve is going to make a decision next week to increase interest rates. Now, markets have bet with like 99.1% certainty that the rise in interest rates is going to be 0.25% or 25 basis points. I posted sometime earlier this week that I wasn't convinced that was going to be the case, that it could be as high as 50 basis points. After these GDP numbers come out, after employment numbers have come out in the last week, I'm actually still on the side that we may be in for a surprise, and it may be 50 basis points. And in that case, the market is going to have one heck of a negative reaction. So the money supply growth rate for December was a negative 1.3%. That's the lowest ever, marking the first ever decline in M2 based on all data available since the Fed started publishing data on M2 in 1959. November's growth was already at 0.01%, well below the peak of 27% growth in February of 2021. So what that essentially means is that the Federal Reserve has stopped printing money, right? The money supply is actually decreasing, and that's happening through a variety of different measures, not simply interest rates. It's not simply the Federal Reserve selling securities and that sort of thing. So let me see. Hi, Jason. Happy Friday, my time. Did you add any Tesla in the last few weeks? I must say that Zach Kinhorn is probably the best CFO going around. Actually, I did not add any Tesla in the last few weeks. Even though I would like to add more Tesla in the last few weeks, the reality is I just have too much risk out there right now. I already have some money on margin, and I don't want to be anywhere near the point where a negative turn in the market would cause a margin call. I really don't like selling shares to begin with, but I especially don't like being forced to sell shares when I don't want to sell them. When you get a margin call, that's exactly the worst time to sell. So I'm trying to keep my margin expenses very low because interest rates are rising. I'm trying to keep the amount of margin very low as well. So that was kind of my strategy there. I added little bits here of stock, a little bit of Upstart, a little bit of SoFi, a little bit of Moneyline, a little bit of VTI, a little bit of VOO, a little bit more in some master limited partnerships that I've owned for a very, very long time. Which curiously, that gets me on this subject here. So I go on Google Trends and just take a look at search terms that are out there and what's trending and what's not. And I kind of like to set the interest over time to like really the past day, the past month, trying to get a look at what's kind of trending out there. And some interesting things came up when it comes to stocks, and I decided to go ahead and pull a couple of those on Yahoo Finance so we could take a look at it and take a look at what's kind of worth it and what's not worth it out there. So the first one that I took a look at here was Datadog. So I haven't talked about Datadog in about a year or so, and Datadog is looking extremely appealing at this point. Now, they did have a big run up in price today, upwards of 7.1%. I do think that we're probably in for some more volatility. I do think that there's a good possibility so you can grab it around $70 a share here sometime in the next couple of weeks or so. But this company in particular actually has a fairly low beta compared to the general market. Earnings per share is about a penny right now, but this really is a growth stock. Let's take a look at that right here. Let's go to 2018. We see a relatively steady growth in earnings, and we see moderate growth in losses in that time period, meaning they're not having outsized losses in returns for outsized returns in revenue. This is a growth company. They're keeping their losses limited as they're growing. And what they do is this. So they provide monitoring and analytics platforms for developers, information technology operation teams, and business users in the cloud. This is a software as a service platform that automates infrastructure monitoring, application performance monitoring, log management, and security monitoring. Okay. So software as a service, if you've ever paid any attention to David Sachs, who's probably one of the biggest experts on this business model, software as a service has to scale out pretty large before they make a profit. The numbers just don't make any sense until they do. When I'm looking at this company in terms of a technology growth stock, I feel like they are pretty much on the cusp of starting to return shareholder equity. So volume in this stock was up about 50% over average volume today. They got a market cap of about 23 billion, and they're doing roughly, what was that? 1 billion a year in annual sales in 2021, and they beat estimates for the last 4 quarters in a row. And despite that, they are pretty close to a 52-week low. Their 52-week low was at 61, and they closed out at 75 today with their 52-week high at 184. 52-week high, probably severely overvalued, even factoring in the future value of cash flows. But at 75, it actually looks fairly attractive if I'm able to sit on it for 5 years or more. Like I said, I think they're pretty close to the point where they start giving back shareholder value in terms of retaining earnings and that sort of thing. So, and in terms of actually having earnings over a penny per share. But despite the negative crosswinds here in terms of growth for tech stocks, they have consistently beaten estimates over the last 4 quarters. We look at quarterly financials. They're growing revenue over the last 4 quarters as well. This looks like a good stock. And this is one of the top Google searches out there on stocks as of today. One of the things I wanted to cover. So a question from the UK. Any idea why the FTSE 100 is near its all-time high? Living here, I can't see a reason to justify this. So number one, it could be a bear trap. That is definitely a possibility that Anthony Walker brought up. The other reason here is you need to factor in inflation as well. Meaning, what does the fact that the FTSE 100 is near its all-time high may actually mean it's 11 or 12% below its all-time high due to inflation. The other thing is, let's always remember that the stock market is a forward pricing mechanism, right? For the economy, it's pricing in where it thinks the economy is going to be 9 months, 12 months from now, not what's going on today. I think almost everyone who's a kind of a professional in the industry says that if we're going to have a recession, it's probably going to be in 2023. It looks like it's going to be shallower than we expected. And it looks like we're going to have some persistent inflation above 2%, but maybe not too far above 2% to make everything very uncomfortable. The other thing I would say is that kind of the collapse in natural gas prices is probably the biggest thing. It's just created a lot of optimism. Whether or not that optimism is 100% justified, I'm not sure, but that's one of the things we should definitely think about. I think it's a little premature to look at European economies and say they're coming out of a recession. European economies, in the main, have been suffering since 2008, and 2020, the beginning of it, is when we really saw them first start to climb out of the doldrums economically. And then COVID happened and crushed them. And we saw them start to climb out again. And then the invasion of Ukraine happened, and that sort of crushed the economy there. So there is some pent up frustration economically. I think that any positive signs right now are being jumped on, but a lot of different factors there. So another thing that keeps coming up, and I've had people ask me about this on live streams before, is new holding. For a moment, for really low action today to bring this in. But New Holdings is a financial service provider that provides kind of a back end for fintechs. They are concentrated in Latin America, and it's a growth stock as well. And then I believe they are a client of Galileo. I'm not certain of that. They've had fairly good growth annually since 2018. They're close to $800 million in revenue right now. And I was taking a look at the sort of geographic distribution. They're very big in Brazil and a little bit less big in other countries in Latin America. Recommendations for this stock are kind of all over the board here, with a couple of underperforms, some holds, 7 buys, and a strong buy. So buys outnumber holds. There are no sell recommendations, but mean recommendation is a 2.3, just over a buy here. Let me see here. Like I said, revenues have jumped up fairly high in 2021. I would like to see Q4 earnings. They beat 4 quarters ago, but for the last 3 quarters, they've met expectations. I want to see what's going on February 14th. But they're kind of in the same boat that a lot of fintechs are in right now. Some of them are beaten down justifiably, and some of them are not. So it looks like the market will run like in 2020. Man, I hope not. I really hope not. I hope that the market run this time around is a bit more sane. I look back at some of the videos that I made on a couple of stocks in 2020 and just sort of winced. Those are ones that I deleted a long time ago, but I sort of winced in that case. I guess the biggest disappointment for me in my portfolio is not necessarily Tesla. It's actually Unity stock. That is my biggest disappointment. I actually tend to sell cash covered puts when I want to get into a stock, meaning I have a set price and I want to get into it. I sell a cash covered put. If it doesn't fire off, then I actually take a look at take a look at raising my price target there. But a lot of times I don't. I just keep selling a cash secured put on there, generating that income, and maybe go out and buy something else. Unity is one of those stocks where I definitely got caught out in the cold. It's somewhere around $30 a share right now. I ended up, I think I sold some puts at like 120, like a year and a half, 2 years ago. Those ended up not firing off in the time frame, but my acquisition cost for Unity was something like $77 a share. So I'm underwater in those. And it's going to take a while for me to get back to that position. So, but no, that's probably my biggest disappointment from last year is in the fact that Unity really hasn't done poorly in terms of revenue, but they haven't grown as fast as I expected them to in terms of revenue. The volume of new development on their platform, it hasn't been as great as I thought it would be. So New Holdings, this company said it operates a digital services platform and technology company primarily in Brazil, Mexico, and Colombia. It offers new credit debit cards, ultraviolet credit debit cards, mobile payment solutions, and the ability to receive transfers, pay bills, and make everyday purchases through their mobile phones. They are really a competitor to Galileo and therefore SoFi, but I think they're also a client of Galileo too. Don't hold me to that. And I think they may also be a client of Technisys. I'm not really sure. I saw one article that said they were, but there's no indication on Technisys website that they are. At least not one that I saw in the few minutes that I took to research this. So this is a company that you may want to take a look at. It has really high volume in terms of trading. It has a high market cap. Price, you can't comment on whether or not it's fairly valued or not, just because they are not a profitable company. This is a growth stock. I have not done a sort of back of the napkin calculation on where I think that their future cash flows are going to be worth. But this is one of those stocks that popped up a lot on Google search that you guys might want to take a look at it. There may be some room for a short-term trade there. I don't do a ton of short-term trading. This is the one that I don't understand. This was one of the top searches on Google in the last couple of days, Mullen Automotive. Mullen Automotive has been billed as a disruptive EV automaker, but I can't find a ton of information on what makes them a disruptive EV automaker. They have an average volume of 218 million shares trading hands per day. That is, let's put this in perspective here. Datadog, which is worth 23.7 billion, has $1 billion in revenue, has about 4 million shares trading hands per day. Mullen Automotive, which has a market cap of 552 million, which has no revenues and negative $5 per share in earnings, has been around since at least 2018. They've got 218 million shares changing hands. This has all of the makings of a meme stock. I don't care the news that they added key hires across EV programs. I don't really care. I don't. There's something weird going on with the popularity of this stock. I wouldn't be surprised if they suddenly got popular on Reddit for no good reason here. Their earnings has actually exploded downwards in the last couple of years, and a lot of it has to do with the fact that they finally went into they're trying to produce vehicles, but as far as I know, they really haven't delivered anything. And so it's definitely a penny stock. This company is based in California. Mullen Automotive. I don't know what autos they produce, and I haven't heard a lot about them. But for some reason, they're on Google today. So let's see who they hired. I don't, like I said, I don't really care about this. And this is located in Brea, California, as well, which is not a hot spot for EV development. So it's an emerging electric vehicle manufacturer. Announced a number of hires who have joined the company. Individual new hires will be working across Mullen's different facilities, including the commercial vehicle team in Troy, Michigan, the consumer vehicle team in Irvine, and the powertrain and battery group in Monrovia, as well as a manufacturing plant in Tunica, Mississippi, and the Mishawaka, Indiana factory. So, I don't really know any of these people. And they're also announcing commercial sales, service and parts. So it looks like they're probably going a different direction. So, but yeah, so I said I just don't know enough about these companies to have an opinion. I will say that this one's a little weird. All right, this was a little weird that it's the top of the searches. This one actually surprised me. Lending Club was also at the top of searches. They were down 11.4% today on forward guidance, really. Forward guidance is basically, and put it this way, I think the market cap for this company may actually be a little bit low. I think that this company may not put you in a value trap, meaning that it may be a little bit unfairly beat up. A lot of times when we look at a company and say, wow, it's really undervalued, there may be a very good reason for that company to be undervalued, that its long-term prospects look pretty dim. Lending Club, on the other hand, has been in business for quite some time. They've been making money for quite some time. Their earnings per share at 2.71, this is for last quarter, puts their PE ratio at 3.36. So on the surface, it would look like ratio being them being a lender, it may look this could be a value trap, meaning that the value could be down for a very, very reason. They missed expectations in Q4 of 2024 or 2022, which they announced either yesterday or early this morning. I'm kind of losing track here, by a penny, which is not a great deal. But it was the forward guidance issued, which was saying that lending volume for origination is going to decline. That's what really caused a drop in the stock price. So this is a company that's doing fairly well in terms of revenues. At least since 2020, their lending volume has gone up. They were briefly profitable in 2021, which a lot of companies in the lending space, the fintech space, can't ever have claimed to have been profitable at this point. And their profits in 2022, they made $289 million on $1.27 billion in revenue. And yet we do have recommendations to sell this stock. Okay. So at least we have one downgrade to, or one sell stock with a mean recommendation of 1.9, which is a little bit higher than I expected them to be. But I hear a lot of negative news about this company, and I've even been really hesitant to talk about it in the past. But having taken a deeper look into their business, this could be an acceptable risk. Once again, on a longer time frame than simply 2 to 3 years, but it could be an acceptable bet here. It's pretty close to the bottom of its 52-week range as well. We're also looking with increasing interest rates as well, especially further out on the risk scale when they get to those, C, D, and E level borrowers. They're probably looking at interest rates in the 25 to 30% range. They're going to see a little bit in the way, more in the way of defaults. But just like Prosper, Lending Club has made real progress in terms of their algorithm and determining who's likely to default and who is not. And they're probably going to have a lot fewer defaults than they did in 2008. But yeah, should we all be worried about New Holdings 4.6 billion outstanding shares? So I actually did 4.6 billion in outstanding shares. If they've got 4.6 billion in outstanding shares, and volume is 28 million shares a day, that's actually fairly low turnover for that many shares out there. So without more context, and probably without more research on my part, I couldn't really tell you one way or another whether we should be concerned about 4.6 billion outstanding shares. Although I will admit that does sound like a fairly large number. Yeah, I'm having a hard time understanding why the market cap of this company is at 19.82 billion and they got $800 million in revenue. I guess when I look at, so roughly 50% growth here on roughly 100% growth, market cap right now at that amount is probably a hangover from the 100% growth that they showed between 2020 and 2021. I want to see numbers for the growth in 2022 compared to 2021 and to see what that looks like. I think that kind of market cap may be a reflection of people betting on a repeat of 100% growth. That's obviously not going to happen. So I got money on the side, and I'm not sure if we should all go in. You think it was the bottom? I think the bottom was October 13th of 2022. In fact, I made a video on that day saying that was the bottom. And that was the bottom simply because of the breathtaking breadth of buying that went on that day across all sectors of the market, across all stocks, everything. And that was the day that many of the institutional investors basically said things are as low as they're going to get and let's buy in. And we've bounced around that bottom a couple of times. We haven't pierced through it. And that was right around 3,600. And that was, or was it, I don't remember exactly how low it was. I think it was right around 3,600 or so. But that was where, but I did remember I looked about a month ago and that was still the bottom, was that October 13th time frame, right around those days. So do I think that this is the bottom now? No, I actually foresee at least before June 30th, and there's something done on the debt ceiling one way or the other, that the political fights are going to cause enough uncertainty that we're probably going to see a decline in the market from this point sometime between now and June 30th. Like, I think this is probably, like, today was probably the last day of big rises that we're going to see. And it's going to be incremental gains from here on out and a little bit more in the way of volatility. So I think that the NASDAQ in particular, it's possible that they retrace a large portion of the gains that have already been made this year. Some of that was just snapback. So I think, I don't know, if you've got a lot of money sitting on the sidelines, remember that no one's got a crystal ball, including me. But I can tell you one thing that I will crystal ball is that the fight over the debt limit is going to be done really for public consumption, meaning that basically the entire argument is a product that is going to be developed and packaged for political, for scoring political points. It has no real bearing on what the government is actually going to do. They are going to make a deal, and the debt ceiling is going to be raised. The caveat is going to be is there's probably going to be some sort of compromise on reducing the budget, but the reduction in the budget is once again going to be something that both parties can go back and say, look, this is what I did for you, but it's not going to have any real effect on how much the budget grows. And we are going to see a larger budget for 2023 than we did for 2022. We will not see an actual budget cut. We're going to have some promises that certain programs that are highly visible are going to be cut. But all of that is going to create uncertainty over whether or not the United States is going to default on its debt. And I don't believe that the United States is going to default on its debt. It's not going to come to that. One of the biggest things it can do to sort of stretch out beyond that June 30th deadline is basically just change the order in which certain federal obligations are paid and prioritize paying back debt. So I don't know if you guys even remember the last time that this debt ceiling fight really happened. That was, I believe, in 2017 or 2018. So I had a number of Coast Guard members who train at my academy, and they were not able to pay their bills because they were the only members of the armed forces that did not get paid, because their pay was they're paid under the Department of Homeland Security rather than the Department of Defense. I don't know that that's still the case, but in that time period, they weren't paid. And let me tell you, they were not happy. Okay. And that's something that I don't think that anyone wants to explain to the military, is that bondholders got paid before you did. So I expect a deal to happen. I don't expect it to be substantial in any way, because no one wants to have the real conversation about saying our spending is out of control and we have to cut spending. Because I'm not like a household. If my spending is out of control, eventually creditors are coming after me. I can't just print more money to get out of the problem temporarily. But between now and June 30th, we're going to have a fight on our hands politically. That's just what's going to happen. So market declines will happen in that, and that will provide probably some great opportunity. And then remember, again, October and November, there's an additional debate on approving a budget for the next year. Some of that debate over budget may actually just get postponed to that November timeframe, right? That October, November timeframe. So they'll raise the debt limit and then have a big budget fight in October, November. And then we'll get another budget that doesn't make any sense and doesn't really do anything to address issues. So, yeah, I'm incredibly optimistic about this, in case you can't tell. But yeah, so if you got money on the side right now, I'd dollar cost average. In most cases, I would say dollar cost average. This is one of the best cases of dollar cost average. I would wait for something to happen, because it's going to happen, and start dollar cost averaging from that point. It's not all, puppies and flowers at this point for the market. I don't think puppies and flowers really comes and for the next year or so. Right now, just enjoy a little sigh of relief. Enjoy some of the gains we've been making for the last month or so, and just realize that some of it could be temporary. Position yourself wisely. I don't foresee Tesla dropping back to $108 a share or whatever the low is, but could it touch to the 130 range again? I think it could fairly easily, right? I think it really could fairly easily go back to the 130 range as people get distracted about things going on in the wider economy. And let's remember, there are plenty of things here that could disrupt Tesla's vision of hitting 1.8 million deliveries next year. There just are a lot of black swan events that could happen out there, including escalation with the Ukraine conflict, increasing oil prices, which with the new round of sanctions coming on Russian oil, we're probably going to see an increase in oil prices anyway, with another large oil company today announcing that they're going to do $80 billion in share buybacks and dividends, returning shareholder equity rather than investing in new drilling, new development, that sort of thing. That's another really negative sign for the oil industry. They're not investing in expanding drilling. So, big deal is always made over drilling permits issued for public land. Let's remember, states like Texas, 98% of the land is actually not publicly owned. It's in private hands, and you don't need drilling permits from the federal government to drill there. You just ask the property owner. There's this whole industry of people called lease hounds that go out to private, landholders and see if they can, get permission from them to drill. That is the case in many of the Western states where you have a high volume of land that could be drilled that's in private hands. They're not doing it because they're returning money to shareholders. As a shareholder, I think that's great. As a consumer of oil products, it's not that great. Hold on a second. Do you think that the West supplying more tanks will shorten or extend the conflict? So I'm not in favor of shortening the conflict. I'm in favor of Russia being defeated. And I'm in favor of that because they are trying to basically, they want every country that borders them to be in their sphere of influence, meaning that they do what Russia says. They've chosen not to make friends with their neighbors, but to try and dictate what their neighbors do and say on the political stage. You could say that the United States has this sort of relationship with Mexico and Canada, but I don't think you can really make that comparison. You really can't. You can't compare, the United States' relationship with Mexico with that of Ukraine or Kazakhstan or Georgia or Azerbaijan or Poland or any of those other places, right? But I do think also that the West is only committed to supply about 100 tanks. And people are making a big deal over the 50-to-1 kill ratio that Western tanks had in Desert Storm. Look, guys, these aren't the same conflicts. There are dozens of other advantages that Western governments had in terms of, in terms of that kill ratio in the Gulf War. There's training differences. There's air superiority differences. There's intelligence differences on the ground. There's combined arms differences. There's just all kinds of differences there. It's not going to be a 50-to-1 impact with Western tanks finally being supplied to Ukraine. They committed 100 tanks. It's not that big of a deal at this point. And if you look at how many tanks Germany actually has to supply, I think that in total, they've only got about 150 to 200 operational tanks. I think that their sort of tank fleet, so to say, is actually just as much vaporware as Russia's was, and they probably only got somewhere between 150 to 200 operational tanks that they could supply to Ukraine, and they won't supply them all. Neither will Poland, neither will Lithuania and Latvia, Estonia, all of those other countries. So I think it's more symbolic at this point than anything else. It remains to be seen whether or not our tanks that we're looking to supply, the M1s, will actually be all that usable in Ukraine. They were designed. It's a much heavier tank as a main battle tank than any of the other ex-Soviet designs that are out there. So I don't know that it's going to do that. So, but extending the conflict is not in the interest of the United States. Shortening the conflict is not in the interest of the United States or Ukraine. Russia needs to be defeated on the battlefield, and that's going to take time. If you look at the history of Russian warfare, they're not doing anything much differently than they've done in the past, which is take horrible losses and grind their enemy into dust by throwing bodies at the problem. That hasn't changed, at least since the Crimean War. That has been their thing. So I'm not sure that we are seeing the war the same way that they are in terms of commitment. And yeah, I do see this lasting for quite a bit longer than we envisioned, but maybe not longer than the Kremlin envisions. So I think that there's a huge misunderstanding between us and them. Okay. And I think that the Western media, in many cases, is not doing us a lot of favors when they talk about extending or shortening the conflict. The basically the way that the world order has worked in the past, 70 years since World War II, is it has served to prevent a third world war, meaning that the United States has been the guarantor of free commerce around the world to a degree, and hasn't always done the right thing, but it's been largely peaceful, largely peaceful. So, do you think Rivian could run out of money? Yeah, I do. They're having a lot of trouble ramping production. It's probably going to be a lot more expensive than they originally envisioned. The last time I looked at their war chest, they had something like $8 billion, but they were going through pretty much like $500 million a month in terms of trying to ramp production. So yeah, it's a big deal, and I think that the collapse in their share price, the fact that capital has become a lot more expensive, and the fact that the secondary share market, meaning secondary issue market, has cooled precipitously, has lowered their chances of being able to raise additional money cheaply. And that's going to add to their expenses. So, yeah, it's a big concern. You see here. Dewey says U.S. tanks are turbine rather than diesel powered. Operated training is going to take much longer. Yeah, and maintenance is a lot. They require a lot more maintenance as well. Like, I really don't see them getting more than a few M1 tanks. And while I guess they could make a difference somewhere along a front, a certain battle space, let's remember that this front is something like 1,500 kilometers long. Right, this is a really, really spread out conflict. And 100 tanks, no matter how good they are, when they're basically encountering an enemy that has air superiority but not air supremacy, is still going to be a problem. It's still going to be a problem. I'm not convinced that the Ukrainian army is as good as everyone is claiming that they are. I think that they're good, and I think that they've done really far better than anyone expected. And I think that their ingenuity is absolutely amazing. Resilience is amazing. But they haven't, and I said this before, they had a large offensive. So maybe this is another thing. I said before that they haven't demonstrated the ability to take back large swaths of land. And literally the next freaking day, the entire front up in Kharkiv collapsed, right? Right after I said that. And then, a month later, they ended up taking Kherson. Still, in a lot of those cases, there was a lot of ground preparation ahead of time. That kind of like gave the signal there. In terms of 100 tanks making a difference, man, I just don't see that it does. And other than the United States, nobody else in Western Europe has a large volume of tanks to give away. I think that Ukraine still has something like 2,200 tanks, which is pretty much exactly what they started the war with. And a lot of that has to do with the fact that they have a lot of captured Russian equipment. I think that our long-range artillery has made a much larger impact. And I think that our air defense systems from the West coming into Ukraine are going to make a large impact as well. But this I just don't see this as being anything less than a generational conflict. I think that even if we shorten the war now and had a ceasefire, it just leads to another war in the next 10 years and probably a third war after that. This is a generational conflict where Ukraine created a distinct national identity in the 30 years or so that they've been free. Now, they've always had a distinct cultural identity that was apart from people that were ethnically Russian. Ethnic Ukrainians speak a different language. You are a different culture. But they didn't have a distinct national identity until after independence. And really what solidified Ukrainian national identity was the seizing of the Crimea in 2014. That's really what it was. And basically Russia sponsoring these separatists. It's really strange the way that the United States, because we are essentially a separatist nation, why we sort of accept separatist sentiments in countries that are multi-ethnic like ours is when it's convenient, and we support separatists when it's also convenient for our national interests. So I view the Russia as basically an imperial power, even though there's supposedly a federation of independent states, or it used to be the Commonwealth of Independent States. Now it's the Russian Federation. I still view it as an empire, and I see this as not even the final conflict or final dissolution of the Russian Empire. I think there's going to be a lot more separatist movements going forward. I think that the Buryats in far eastern Russia are probably going to be next, and the area, and that's Buryatia is one of the places that Russians tend to dump dissidents, and so they may have a lot more people. Let me see here. Do you think Poland or Lithuania are at risk if Russia wins in Ukraine? No, I don't. I think that was the goal, is for Russia to take Ukraine really quickly and then to roll over. And basically, they would control the Bessarabian Gap at that point, because they would also control Transnistria. So they would basically control the Bessarabian Gap there. And a lot of people were saying that Moldova was next. I would say that's absolutely true, because they're not a member of NATO. But the war against NATO would not have come immediately. It probably would have come a lot later, when Russia had more confidence and they thought they had experience. But I think that realistic voices in Russia right now are probably saying that war with NATO would be utterly suicide. At least a conventional war with NATO would be suicide. And then invading Poland and Lithuania and saying, hey, these countries are now under our sphere of influence. Look, Poland, Lithuania, Estonia, and Latvia, they're not a part of NATO because they want to be a part of the U.S. sphere of independence or of influence. They want to be a part of NATO to be independent of Russia. That is the point. I don't think they cared whose sphere of influence they follow under. They just don't want it to be Russia. Like, they were willing to join an alliance that held Germany, that 2 generations ago was a mortal enemy, rather than still remain under the influence of Russia. Russia wasn't hated because of the Soviet Union. It wasn't hated because people are Russophobes. It was hated because of imperialist Russian behavior, period. That's it. It's still utterly reviled anywhere in Eastern Europe. It's utterly reviled, with a few exceptions like Serbia and a large swath of Hungary, which I don't get. I really don't get. Like, it's like I tend not to comment on the internal politics of of another democratic country. Even I haven't made too many comments on Viktor Orban, but man, did you forget 1956? What's going on here, buddy? And like, literally, it seems almost traitorous, the degree to which he's willing to lick Putin's boots. So yeah. Anyway, I don't generally make openly disdainful comments about foreign leaders like that, but I'm definitely doing that today. So yeah, but in terms of economically, what's happening with the war in Ukraine, we are going to have to do something really drastic when it comes to the supply of fertilizer. We got kind of lucky this year that worldwide harvests were pretty good through the end of the year, but we are having water issues here in the Western United States, and which is a huge area of food production. Even people in the United States don't realize how much food Southern California produces. We produce something like half of the nation's like fruits and nuts. But in terms of overall produce, we produce a vast amount of overall produce. California can absolutely feed itself. It's having water issues at this point, but all over the Southwest, we're having water issues. And a lot of this is in farming areas. The previous summer as well, I believe that some areas in the South ended up having issues as well when it comes to water. But we didn't have fertilizer issues. Going into next year, the price of fertilizer is going to be a lot higher. One of the things that's being noted right now is that's an effect of global warming. That if you have ever farmed in California, you'd realize that something like 19% of all pesticide is actually used here in California. And in the past, it didn't have anything to do with global warming. It had to do with the fact that it was warm here already year round. And we didn't have a winter that was harsh enough to kill off pests, and they were evolved to thrive really well. Like in my garden, I have aphid problems in January. Outside of California, who has aphid problems in January? You don't, because they're frozen. Okay. So we use a lot more pesticides than the rest of the country does. And a lot of those actually are made from petroleum as well. But that's kind of beside the point. But as we are seeing minuscule increases in and temperatures across food growing portions of the United States, we're seeing the use of pesticides grow and grow by a pretty large amount. And that is really concerning, especially when you look at where these precursor chemicals for pesticides come from. And we're actually going to need more fertilizer coming down the road. So we have the facilities here to make that here, right here in the United States. The issue is, can we do it in volume enough to supply us, and not only us, to supply the places that Russia and Ukraine were supplying before, which is mostly in North Africa. North Africa has huge issues. Like, Egypt for thousands of years was some of the most productive farmland on the planet. That was until they built the Aswan Dam, and then you saw gradual salting of soils because you didn't have those annual floods anymore, right? And it wasn't washing out sediments into the ocean anymore, and the soils are gradually sort of salting. Now they've been working on that for a number of years, but it means that area has become far less productive than it was in the past. And now Egypt, for the first time in its history, I think in the last 40 years, has finally become dependent on imports of grain, which is something that never happened before, right? Now that we're seeing worldwide decline in fertilizer production, we're probably going to see wheat prices rise. I jumped the gun on when I thought wheat prices would really rise. I bought some wheat futures and made about 10% of them. Really thought that I would make a lot more, though. I think that this year is probably going to be the time where we see wheat prices really rise. And if wheat rises, we're going to see substitutions in certain things. When wheat and barley prices are going to rise, the areas that are going to be most affected are wheat and barley producing regions. And it's in the manufacture and beer that we're going to see a giant, and I'm not saying this just because I own a bar. I'm saying this, that a lot of companies in the United States that make beer use substitute grains as fermentables when wheat or barley is too expensive. So you use a majority of wheat or barley in order to get the taste that you want, but for the rest of that fermentable grain to get the alcohol in there, a lot of times there's rice or corn mixed in there. That's why Budweiser manufactured in the U.S. is not even going to qualify as beer in Germany, because it might have corn or some other fermentable grain in there, something that has the sugar in it that's fermentable. We're probably going to see increased use of corn and rice, and that's going to and those prices are going to be pushed up as well, because it's going to be a replacement for wheat and barley, mostly barley. And if you don't think that this is, I'm being serious about this, you really have to look at the volume of beer that is consumed on the planet this year and how that affects barley prices, and how increased in a second layer fermentable in there might actually cause an increase in corn prices, might actually cause an increase in rice prices as well. So I do think that we're looking at elevated food prices for the rest of the year. You can probably look for egg prices to come down, though, even though my family and I are in discussions right now. So as far as whether or not we want to raise chickens, I'm in favor of it, just because we have this unused kids playhouse that I built a few years out in the backyard. They're now too old to play in it. I'm going to turn the bottom floor of it into a chicken coop, I think. And, but I have to, but I'm not necessarily doing that just because of egg prices. I'm really doing that because it's a great way to dispose of and get fertilizer for my garden. Yes, it's going to save some money on eggs, because I do eat a ton of eggs. But I got to figure out a way to do it without needing extra calcium supplement. Anyway, guys, I'm coming up on an hour. Went through a really wide variety of things today. Did want to cover this last thing here. Energy Partners has popped up big time in search as well, which is a bit curious because it's kind of a boring stock. It is a master limited partnership, meaning that when people look at earnings per share and price to earnings ratio, you shouldn't, because the rules for master limited partnerships are that you have to distribute up to 90% of your earnings to shareholders in terms of a distribution. It distorts what we think of as price to earnings ratios and earnings per share, because they have to distribute that income. They can't use it to reinvest and grow, right? They mainly grow by having secondary offerings or taking on debt. And the dividend yield is at 8%, which is a little bit high right now. Not necessarily indicative, though, of a dividend that can't be sustained. You need to look at coverage ratio. But people got excited about this stock during when the price of natural gas went. They do sell, this company does sell natural gas, but the majority of the revenue actually comes from piping natural gas from place to place. I think they own like 19,000 miles of pipeline or something. I'll say 11,600 miles of natural gas transportation pipeline. That is how they make the majority of their business, is by the volume of gas that they're pumping. Now, if we had a particularly cold winter or something like that, or then that would make a big difference. I'm not going to get too excited. I'm excited about the dividend yield. And if I go back and I look at this company and I see that the coverage ratio can sustain this dividend, then I would possibly consider buying even at this price, right? But I'm telling you that at that dividend, the 52-week low of around $9 a share, $10 a share, when I'm looking at this as limited partnership, that would have made a lot of sense. These companies don't grow as quickly as regular, C corps do, right? Or whatever, or S corps or LLCs or whatever it is that owns stock, where you own a slice of that company. They can retain earnings and use that to reinvest in the company. They don't grow as fast as that because they have these obligations to distribute. If you like the dividend yield and you're comfortable with price going down from here, and you think that dividend yield can be sustained, then this is a good purchase. But I suspect that the interest in master limited partnerships always goes up at really weird times, and people get caught in these traps where they don't really understand how a master limited partnership works. So if you're looking at any of these energy companies, you really need to take a look at whether or not it's a master limited partnership or not. And I urge you to do your research to understand what it is. They don't grow at the same rates that like an Exxon would, or a Chevron. And they focus on return of shareholder equity rather than growth. So it's a very, very different ball game. So I don't know if you guys saw my video that I did earlier on so far, but I'll talk a little bit about as get part of the storm in the long run. When it comes to them being sort of the backbone of the financial industry, this is kind of a scroll of the clients of Galileo right now. And there are some names that I've used, particularly outside of the country, to do business on, like financial apps, like Remitly, and a couple of other apps on there. And they are sort of the back end for these new SoFi players. And Dave, of course, fintech app that's traded on the NASDAQ. I think it's traded on the NASDAQ. Toast, of course, uses them. That's a huge customer. Wave is a large customer. Let's see, Checkbook, Oxygen customers. Pomelo, never heard of them. Elvis is familiar for some reason. Anyway, there's a huge list of clients that are here. And this is why they're going to build that business at 30, 40% per quarter for the next couple of years. Probably going to grow at 25% per quarter after that. And they're going to continue growing that business to where in 3 or 4 years, it's going to be a third of their revenue. Banking operations is going to be a third of the revenue. Financial services is going to be a third of the revenue. And from that point on, I really expect the sort of Galileo, Technisys, SoFi, fintech backbone to actually outperform the rest of the actual client-facing app that you see with SoFi. They're looking to become the Amazon Web Service of the new digital economy. They really have a first mover advantage in this case. Even Moneyline, which is the other app that I like, and another as well. So this is a video that I did this morning. I kind of rambled a little bit in it, but the very end of it, where I talk about their plans for becoming the Amazon Web Services of the fintech world, it's because no one really wants the expense of developing, maintaining, and managing security for your own full technology stack. You can pay a subscription fee and have that done for you. E-commerce has already gone this way. If you're on Shopify, everyone's being it'll say powered by Shopify, real little letters at the very bottom. But if you're on a Shopify store, Shopify itself uses Amazon Web Services. It's a derivative service of Amazon, right? But it's far cheaper for me to use Amazon Web Services through pay $29 to have a little website that sells no more than 30 items a month or something. Credit cards, credit card services, payment. I can even take Bitcoin. I can even take crypto on it. I can maintain all of my inventory. I can print T-shirts on the fly, and I can do that for $29 a month. Right? Why would I go through the expense of spending tens of thousands of dollars to develop my own e-commerce platform, then have to deal with, signing contracts for payment systems and all that? I'd set this up Shopify, and it's been running for years, and it does like a few T-shirts a month, right? And that's all it needs to pay for itself and give me a couple $100 a month in profit. And it's literally just a couple $100 a month. I mean, do that, but Galileo, Technisys, and all, they're looking to do the same thing. And the big thing that this is going to take cost-wise off of the plates, the cost of compliance, complying with regulations and laws. And that is a giant deal for financial companies. There's a whole department of people that are highly paid and really annoying that they're going to, yes, I hate compliance. They're highly paid and really annoying. They're going to be able to cut those people completely out of the business, and it's going to be done automatically. So that is how they're going to become the financial empire that we all expect them. Like, if they had that 29x return that I saw some video talking about, it's going to be on the back of these two services combined into a single platform. Anyway, guys, it is time for me to take off today. Thank you very much for attending. I'll next week as well.